Hello, everyone, and welcome. I'm Elizabeth Engler-Modick, Editorial Director of GIE Media's Manufacturing Group of Magazines, Today's Medical Developments, Aerospace Manufacturing and Design, and EV Design and Manufacturing, which was formerly Today's E-Mobility. And I'm excited that everyone is joining us for this webinar. Your presenters today are Florence Joffroy-Black, CEO, President, and Founder of MedWorld Advisors, and Dave Sheppard, Managing Director and Co-Founder of MedWorld Advisors. And they are also the authors of Today's Medical Developments, MedTech Mindset Monthly Column. MedWorld Advisors is comprised of expert merger and acquisition professionals, from advisors to M&A lawyers to past CEOs, who have grown and sold companies, as well as key executives in Fortune 500 companies. Now, before we head into this presentation, I'd like to thank our 2022 webinar series sponsors, ISCAR and Renishaw. ISCAR is the largest of the 15 companies comprising IMC, International Metalworking Companies, and has been a leader for nearly 70 years in the development of a dynamic and comprehensive line of innovative precision carbide metalworking tools. They have developed industry-specific solutions to optimize productivity. They understand the unique requirements of each industry and continually improve and introduce new ideas for machining intelligently. And our other 2022 webinar series sponsor is Renishaw. They are a global leader in developing technology that supports manufacturing process control. Renishaw offers an advanced range of calibration, measurement, positioning, and inspection solutions. Specified by leading OEMs around the world, Renishaw encoders, calibration, and measurement systems enable superior process control down to nanometer and picometer levels. Additionally, I'd like to thank today's webinar sponsors, Kyocera SGS Precision Tools and Makino. Kyocera SGS Precision Tools is a manufacturer of industry-leading round solid carbide cutting tools. KSPT is proud to have pioneered some of the world's most advanced cutting tool technologies, resulting from rigorous product coding and material testing within its Global Innovation Center. It is this commitment to innovation that has launched patented products and technologies. KSPT technical sales engineers, application specialists, and distribution partners blanket the globe, delivering reliable service and support to all markets. And Makino, a global leader in the machine tool technology, has a rich history of developing innovative solutions for part manufacturing. Makino is committed to providing high performance, leading-edge machining technologies, and innovative engineered process solutions that enable manufacturers to focus on enhancing their productivity and increasing their bottom line. Makino offers a wide range of high-precision metal cutting and EDM machinery, including horizontal machining centers, vertical machining centers, 5-axis machining centers, graphite machining centers, and wire and sinker EDMs. Makino's flexible automation solutions provide reduced labor costs and increased throughput in a variety of production volumes and designs. Makino's engineering services offer industry-leading expertise for even the most challenging applications across all industries. Now, before I hand everything over to Florence and Dave, we will gladly take your questions that you may have for them, and you can simply type them into the Q&A box at the bottom of your Zoom screen, and we'll get to as many as possible. So with this, Florence and Dave, I'm going to hand the Zoom platform over to you two.
Thank you.
Thank you, Elizabeth. That's a great list of sponsors. Perhaps maybe they want to buy something. They might now know somebody who can help them with that. So thank you for the introduction. Thank you for the opportunity to be available here today as MedWorld Advisors to speak about MedTech M&A in 2022, if it's still a seller's market. I'm Dave Sheppard. I'm co-founder and managing director for MedWorld Advisors. I have a background in the Fortune 500 world in the MedTech industry for many decades now, as you can tell by some gray hair that I have up here. I either earned that in the industry or from several of my teenage children that I've had. As I've gone through the industry, I've had the opportunity and really the blessing to be able to meet great people around the world. I've helped to launch products in every continent around the world except for Antarctica. So I've helped to sell something to to almost every particular type of group, except for maybe penguins. So I'll be working on that in the future. I've also had the opportunity to be involved in mergers and acquisitions, running global business groups. And one of my major roles at Covidien, which is now Medtronic, was the vice president of strategic alliances in the $1.5 billion respiratory group. Did major deals with companies like Philips and Draeger Medical, which had just acquired the Siemens patient monitoring business, and GE Healthcare. And then since at MedWorld Advisors, I've been doing similar things on the other side of the table to help our clients if they're a middle market company. If it's Mary's medical company, been around for a few years, and Mary wants to go play golf, or she wants to find the next business and wants to sell this one, we'll help her find the right owner for that to get it to the next stage and help her get to her next stage. And then we also help early stage companies with strategic partnerships and then leading to exit strategy. And with that, I'll introduce my co-founder and CEO, Florence Joffroy-Black.
Thank you, Dave, and good morning, everyone, or actually good afternoon, depending on where you are. It's a pleasure to be here. So a quick little background on my end. You'll notice that there's a little bit of an accent when I speak, and the reason for that is I'm actually an import from France. I've been in the United States for some time, but born and raised in Paris. I have worked in a lot of different countries, a lot of different places, and so the international marketplace is really where I'm very much comfortable. Worked in for a number of companies, some of them based in the US, some of based in Israel, Europe, or other locations. And like Dave, my background has been in the medical device industry, slightly different than his, heading marketing, strategic decision for companies such as Draeger Medical, but also working on integration. Also worked for startup companies, so I understand what it's like to actually trying to take innovation to market and, fundraising and trying to get through clinicals and things of that nature. But I've also worked for private equity firm, which is a whole different world. And so, as Dave mentioned, we kind of got MedWorld Advisors together wanting to help other companies that really needed some support in understanding the landscape of what M&A actually is and making them successful in their efforts.
And we do have a global team around the world. And Florence, if you go to the next slide, we've also worked our team being based in Boston, headquartered in the U.S., but also offices around the U.S. and in Florida, and California, and several states, also in Canada, 4 countries in Europe, also a managing director in Hong Kong, and collaborators in Japan, China, and India. We have done deals with most major companies around the world. Somebody in our team. So we're very connected in the industry with the strategics, and then we could probably put up a similar private equity slide as far as people that we're connected with through our team. So we've been very active in this space now for the last 6 years. You can go ahead and go to the next slide.
Certainly.
So the question for today is MedTech M&A in 2022. Is it still a seller's market? And that's really a good question. And the reason we wanted to have this opportunity to speak about it, it was something that was topical for, I guess, for some of the readers of TMD. It's also questions that we get asked quite a bit in 2022, because the market has changed quite a bit from 2019, 2020, 21, and now 22. And what we can really say is that it really is still a seller's market when you think about all the attributes that are happening if you're a quality business. And that's really a key thing. And so we'll talk about the numbers and kind of give you some analysis of what's going on in the industry. But the key thing is that if you're running your business and you're doing a great job and you're developing a quality business, there are buyers that want you, both financial buyers and also strategic buyers as well. And we'll talk about the reasons why, and we'll go through that and we'll summarize it at the end. But the good news is it really is still a seller's market. In fact, some ways, it's probably more of a seller's market right now than a buyer's market in MedTech. We're focused on MedTech because there are not as many good quality companies out there for sale as some of the buyers would like to see. So if you're a good quality company, you're in the driver's seat. You can name your timing if you want to do it this year, next year, the year after that. It's really your call, your control. It should be. Keep building the intrinsic value of your company, and it will be a seller's market for you. And just really work with the right process to be able to find the right buyers and get the right deal that makes sense for you. So that's the high level. we'll get into it. And at the end of the day, like this cartoon says, we basically want people to find each other and want it to be a good union when they get together. So it's not only the transaction, but it's the outcome that takes place afterwards. And that's one of the things we like to do at MedWorld Advisors is help people get together and not only have a successful event, but a successful post-event.
So with that in mind, as Dave mentioned, we're in 2022 and we're trying to understand what the future is going to look like. But we need to go back to 2020, at least the last couple of years are really going to show us how the changes have actually taken place. So I don't think I have to remind anyone to the fact that 2020 was very much an unusual year. We had COVID that really hit the marketplace at a global level and created not only health issues, but also supply chain issues. And so if you were in the supply chain management and you were in manufacturing, you probably encountered some issues. Depending on what industry you were in, as you can see from this chart, you had different size of impacts. When it comes to healthcare actually did fairly well in 2020. Why? There were a lot of needs when it comes to medical. So just look at ventilators, just that alone. This is a device that in the United States or even at a global level, we were short of. And so it created opportunity for ventilators to actually, be on the market. And there were some distribution agreement, there were some licensing agreements, some deals that were made. We actually did one of them. So if you participated in one of our previous webinars, we talked about what we did for Aeron in Florida, but also the licensing agreement that they had with GE and Ford, which we helped put together. So again, if you were in healthcare, 2020 was still actually a fairly strong year. When you look at numbers, though, what we need to keep in mind is when you were hearing about trends are numbers, right? But when you look at them in depth, you kind of get a different pictures. And so as we're looking at things at a global level, or at least across all industries, keep in mind if they'd mentioned that we're in MedTech, we're in healthcare, and it's a very unique segment.
And Florence, if I could interject, we're already starting to get some questions. We want to make this interactive. So I'm going to take one of them right now, one of them a little bit later, as it'll apply a little bit better later in the presentation. Sure. But one right now is given the ever-rising regulatory barriers to innovation, especially the MDR, is there an increased appetite by majors to acquire smaller players with approved and effective innovative products, simply because of the delay is to be bringing new products to market? That's a great question. And
that could be a webinar in itself.
Right. Yes, it really could. As far as what a faux pas that the EU made, where 12 years ago, companies were launching their product in Europe, not the US, because the FDA was difficult to work with, and EU was a lot easier to get products into. So Europeans were benefiting from innovation, and now it's going the other way around, where products are being launched in US first versus the EU. But to the question relative to M&A, what we're seeing, some of the dynamics that have taken place there is, first of all, there are some smaller companies that the regulatory burden now is rising around the world in a way that's becoming difficult for some of them to maintain it. Not only is it the EU, the MDR, so they're having to update their products to get through that, try to find the right notified body, and then sometimes they don't get prioritized in the food chain because some of the big companies are monopolizing them. So that's becoming very difficult for them. So some of those companies actually, and we talked to a few of them, working with a few, are looking to exit just because of that particular issue that's going on right now. They just don't want not necessarily have that. They love the business they're in. They love the patient outcomes. They love everything, their customers, but the regulatory burden is becoming a challenge for them. And then also in China is always a moving target. And so that's become more difficult in the last 10 years as well. So on a global basis, regulatory issues are really become more challenging for smaller companies, and that is driving some M&A on the seller side for smaller players. On the strategic side, there also is an interest to make some acquisitions based upon the fact that even the large strategics are having trouble with their product portfolio, keeping all of that in the transition to the EU MDR. Some of it just may not make financial sense for them to do so, which is a shame because some patients are losing access to good products. So with that said, then they're wanting to refresh their product lines, and sometimes they're looking for innovative products to be able to do so. So I hope that answers that question. And Florence, we'll keep moving and answer more as they come up. And I got one more question from Ann that I'll answer later on.
Okay, wonderful. So looking at geography and, how countries or continents were actually impacted during 2020, interestingly enough, there is one region that saw a higher number of deals, and that was Africa and Middle East. The rest of the countries all went down pretty much at the same level with regards to, over-year deals. So moving from 2020, which as we know was, an okay year, but not stellar, comes 2021. 2021 was an incredible outlier year. It is by far the biggest year that M&A has ever seen. We actually went into over $5 trillion of transaction value that took place, not just in healthcare and medtech, but overall. And this is due by a number of things. As you can, remember, things kind of were stopped in 2020, people waited, and 2021, people started all over again. What's really interesting is that we also went up not only in the number of deals, but also the value of deals. And we have over 600 deals that were over $1 billion in 2021, which is really an incredible number. One of the contributing factor also was the creation of SPACs, which we'll talk about a little bit later, which really created a whole new environment. And actually, it created such an opportunity that 10% of the global M&A volumes actually are attributed to the result of SPACs, which is really incredible as well. So again, why was 2021 so high? Well, again, less spending in 2020, which means that money was just sitting there and needed to be spent. When it comes to healthcare and medtech, as we mentioned, 2020 was a rough year overall. It was actually good for healthcare and medtech, but it means that if you had money that you wanted to invest, people went to healthcare and medtech for 2021. It was viewed as a safer space, which is often the case for our industry, right? Again, creation of SPACs made a big difference. And then for the companies that were already in our space, they decided to go and invest in areas that would really create a lot of high growth for them so that they actually could catch up and invest in some of the areas that strategically made a lot of sense for them. Another thing that we saw actually is that after being in waiting in 2020, some of the big strategics looked at our portfolio and decided that some companies were probably not the ones that they needed to get as part of their portfolio. And so we saw some divestitures take place. So if you look at some of the big names, we heard about Johnson & Johnson doing a health spin-off. We heard about, GE Healthcare, also doing
they're spinning out their healthcare division, which will be great going forward.
Exactly, right. Zimmer Biomet exactly created, Zimby. All of those things created opportunities. Those companies did a divestiture. They were purchased by other parties. That created some activity in the deals, but that also allowed those companies that sold those entities to actually spend money somewhere else. So if you look at some of the mega mergers, because 2021, I think will go down in record, not only for the fact that it was over $5 trillion in deals, but also the size of the mega mergers that took place. And I just took the ones that were from 1 billion and above. As we mentioned before, there were over 650 of those deals that took place in 2021, not all in healthcare. So these really are the ones that really made a lot of noise. Definitely a lot of ink was spent about those mergers and those acquisitions that took place, but those were made for incredible amounts of money.
So as we go forward in 2022, it's interesting to look at the trend in venture capital investments, because that's really that's part of the flow of the money in the industry. And what we're seeing, one of the trends, just to speak to that as a high level, is that some of the decline in the healthcare investing by venture capital is actually creating some M&A opportunities in 2022. That we're actually specifically working with a few companies that if the dynamics were the same right now as they were in 2021 for fundraising, they probably would be raising the next Series A or their Series B instead of looking at an M&A. However, right now in the fundraising area, the dilution of the valuations are getting much tighter. And when you do the model as an entrepreneur, you have to think about, okay, if I get out now, I get X amount. If I go ahead and raise a whole bunch of money, but at a lesser valuation. That means I could do a lot of work and still not get much more money 5 years from now. So that's driving a little bit of M&A as well, and also I think just some consolidation in the digital healthcare space, which has been a lot of startup over that in the last 10 years, but specifically the last 5 years. And every industry, as it starts to mature, starts to have a little bit of a consolidation with it. So right now, there's been a lot of investment in digital. So I think really what's driving the decline in the capital investments in healthcare specifically, it really is digital health tech is still getting funding. This is an important thing to remember. If you look at declines, we're still seeing high levels of funding across all the segments. It's just a decline versus 2021. But historically, if you look at from where things were years ago, we're still receiving a lot of interest in this industry. So that's something to take heart in if you are trying to raise money out there. I'm not trying to discourage you.
Absolutely. I mean, to this point, if you look at this graph, 2021 should almost be hidden. Again, it was an outlier year. 2022 is above the years that were before 2021. So 2020, 2019, we're still really at a really high rate of venture capital investments.
And so while we're on this slide and talking about that, Ann had asked a question about what stage of companies are buyers interested in. Are they focused on sellers with commercialized products, or is the interest in earlier stage startups? And I can say that the answer is both. So it's a kind of a complicated question, but it's really a good question. The easy answer is that companies that have revenues and EBITDA greater than $1 million, like revenues probably greater than 5 and EBITDA greater than 1 million with growth will gain attention from financial buyers. The bigger scale you get, then the more the strategics become interested in you, depending upon the innovation and technology that you have. Strategic fit really plays a real importance for the strategic players in the industry relative to if they're interested in you at any stage. And that's really what could drive them to think about taking you on earlier, is if they think you have something that really fits into their portfolio or their future portfolio, and they want to grab you before somebody else does. We say that value equals strategic fit plus timing at MedWorld Advisors, and we see that over and over again. So it's more difficult at an earlier stage company to become acquired, because you really have to have that right fit. And you also need to prove that you have traction. You don't necessarily have to have revenue, but what you have to prove is that you have traction. And that's to mean that you're getting, when you go into your user environment, what is your user case? You need to understand what that is, that use case, and you need to be able to get into, even if it's pre-revenue, not commercialized, in that space. Are the users adopting? Are they asking for the product? They want it, they want more. Are you showing that other people want to do the same thing and it's easy for them? If you can build that scalable model, then the strategic will be interested in you, because they're really good at commercial execution. So they're looking for plug and play models to scale. And so what's happened in 2022? First half, we're seeing a decrease versus 21, but as Florence just mentioned, 21 was a record year. So compared to 20 and 19, we're actually still at historically pretty high levels. So that's working out just fine. So what are some of the contributing factors to people overall looking at M&A and maybe having them pause a little bit if they are? Inflation became real. It wasn't transitory anymore. It became real. The war in Europe, that was something we didn't even think about in 2021. In fact, some people in our lifetimes haven't had to think about a war in Europe since World War II, and I wasn't born yet, and I've been around for a long time. But now having a war in Europe has had an issue. And what we find with buyers can deal with good news. They can deal with bad news. Where they become a little challenged in making decisions is uncertainty. So I think there's been some times where they've had a little bit of a pause. Okay, what's going on with inflation? What's going on with the war? Now that's starting to settle down. We're starting to understand it. So we're seeing activity again, especially among the strategics, and then also the buyers that are focused on how they're going to spend their cash, because there are a lot of financial buyers out there that have a lot of dry powder, and they need to spend it. So as long as they don't have the uncertainty that we've had earlier in this year, they can go forward and make decisions based on the information they have today. Supply chain was a challenging in 2021. It's gotten better in 22. There's still some blips in the road, and all that's having some impacts on the economy that we're going to see. Cost of getting dollars is much more expensive, so that's why I think we have some numbers talking about cash deals are a little bit higher right now because the cost of borrowing is definitely going up, and there's a little bit of focus on integration from all the deals that have happened in the previous few years. But I really do want to summarize. I want to make sure that it's really understood that we talk to a lot of buyers, and there's a lot of active buyers out there right now that are looking for opportunities to find the right seller that fits their needs. If it's a financial buyer, it's what core space are they looking into, and do they have financial traction? If it's a strategic buyer, it really is it a strategic fit for me? And then they start to look at the economics and what the valuation might be for that.
Very true. So if we look at overall M&A activities in 2022, if we look at where we are, again, take a look at 2022, and if we don't compare it to 2021, again, the outlier, you will see that actually we're doing really great, whether it's a number of deals or even in the transaction value that have taken place. So it is still a positive outlook for 2022, even if the numbers seem to, tell a different story when you look at it again in a global fashion. So the one thing also that's important to take a look at is the type of payment that are being used when companies actually, make a purchase. And so what is interesting is that actually in 2022, as Dave mentioned, there's a lot of cash, there's a lot of dry powder that is out there, and we're seeing a lot of cash being used with regards to purchases and deals. There's still, stocks and combinations of both, but the level of cash that's being used for transaction has definitely gotten higher. If we look at it by sector, this chart is actually interesting because when you look at healthcare, you have different ways of defining healthcare. And so right now, healthcare is defined as, hospitals and physicians' offices and, some manufacturing and other things. IT is not necessarily part of the healthcare pictures when you look at numbers. And at some point, that's going to have to level off. So when you're looking at the 2022 numbers, you'll see that actually IT has expanded, but there is a lot of healthcare in the IT segment that actually is not accounted in healthcare that actually should be. So if you look at companies that have software solutions, they're going to be in IT, they're not necessarily going to be in healthcare. When you look at the value and the size of the deals, we still have a lot of mega deals taking place. And actually, we're ahead on the mega deals in 2022 compared to 2021. And 2021 was a big year for mega deals. So we're still seeing a lot of really big deals taking place. There's a shift in the balance, but we're only at the half point of the year. Those graphs that we're showing you actually stop at the end of Q2. So we're still seeing a lot of shifts now taking place as we are, into Q3. Finishing Q3 and into Q4. If you look at healthcare, we again are seeing the same story that we've talked about overall, which is that the deal count is down, but it's still a really good number. And if you compare it to 2020 or even 2019, we're ahead of where we were back then. So if you look even at some of the most recent deals, June, for example, if you look at it, we had a lot of really big deals. If you look at the regions, North America and Europe are pretty much head to head with regards to, to the number of deals and the size of deals. But there were some, mega deals that were announced in June that, lead us to believe that we're going to continue on that trend as well. Dave?
Yeah, I was just reading one of the questions that came in. I'll get to that in just 1 second. So in terms of who's buying right now, we're looking at obviously M&A is being driven by private equity. It's being driven by strategics, and then some of it's being financed by venture financing. And one of the questions that we just got in with from William was, is there a generational change occurring among the strategic buyers, and is that changing the methods of deal analysis and risk tolerance within that group? And I would say that Overall, yes, at a very high level, but there's a lot of complexity and probably depth within that question, and it really goes down to culture, and every company has its own culture, and so every strategic definitely has its own culture, and so within some of that, I think we'll see that generational change being a little more evident than you'll see in other companies. But overall, this business is going from, if you're a strategic, you're going from being somebody who 20 or 30 years ago, you were supplying things that were instruments, devices, that sort of thing. It was plastics, it was metals, electronics, and now it's becoming digital med tech. And even if you are providing an instrument, you're providing it with some kind of way of being able to censor, to monitor it. You're playing with an application to be able to understand what's taking place. So it's becoming a digitized industry, both in terms of how you're managing your business, and then also in how you're applying your products and solutions into the marketplace. And that's continuing. So I think there is definitely an analysis that's taking place relative to, it's not only how many widgets can I sell, but how can I have a more effective solution and be able to have evidence around that solution as being effective, especially with an era of value-based care systems around the world, and that's really becoming really important. So it is changing the analysis, and as far as the risk tolerance is concerned, every company is a little bit different. I can think of some companies that are strategics that have been conservative and they're still conservative. And I can think of some that have been aggressive and they're still Stryker's one good example. They've always been aggressive. I don't see that changing. But I am seeing a few companies that historically have been a little slower in M&A or being a little more aggressive to try to catch up and to be able to compete, especially when it comes in the area of enabling technologies and to be able to have digitization. So anyway, that answered that question, I hope. And then somebody else asked if we'll share our slides after the presentation, and yes, I believe we'll address that at the end. But I think this will be available online if I recall correctly. So moving on from this slide, Florence. So what's going on in 2022? We've been really talking to us. We're kind of getting to summarize it. In summary, the first half of the year was a little bit slower. It's just been about finding the balance, but again, it's contextual when you think about being a little slower, because it's still really comparable to 2020 and 2019 and 2018 levels. So it's a decline from 21, but 21 was just as a record year. There's still a lot of money to be spent. Middle market deals, we're seeing them. MedTech will remain very competitive, and part of the reason is historically, and we've talked about it a little bit in this presentation. Financial buyers will trend towards MedTech during times of slowdown and uncertainty, because MedTech is a stickier business in the long term. The demographics of people like myself that are getting older, it still continues to work in the favor of the MedTech business. So in other times of high growth, you might get into energy and more diversified types of things. When you get into a slower growth, you come back to MedTech because it's a more stable business in the long term, and we're seeing that. So middle market deals are becoming very sought after, and they will remain very competitive. And that's what we're seeing, because there's a lot of cash out there that still needs to be spent in terms of the private equity. And then there also are a lot of strategics that are still trying to fit what's the next thing they need for their portfolio. Early stage deals may have people are still interested in them, but they may have greater valuation gaps based upon what's happening with the fundraising in the digital space coming down. People are still interested in investing in it, but they're not given the same values that they were before. So things that might have been 23 times revenue in digital a year ago, there might be 14 or 15 now, which is a difference. So you have to decide if that's something that you would want to take. If you're still having a good SaaS model and a good revenue and good growth, you might still be able to get the 20 though if you're in the right space. So that's the key. Keep running your business and create your own value, and let the marketplace decide where your market value is, working with the right advisor at the right time. So in terms of the financial buyers, people are always asking us, what are they looking for? The magic formula that we're continuously asked for almost on a daily basis is $2 million of EBITDA and higher. And we put 2 to 20, but they'll take more. The bigger the deal, they're happy to get involved. The bigger it gets, the more they get involved in competing with strategics for the deal. So I think that is kind of the sweet spot for a lot of them, is these 2 million to 20 million in terms of EBITDA. And what they'll do with it, depending on the size and where they're at in terms of their needs, they'll either establish a new platform company, that's what they'll call it. They'll maybe purchase a contract manufacturing company if they're not in that space, and they'll make that a platform for contract manufacturing, and they'll use that to go buy other entities to build onto it. And maybe they do contract manufacturing, but not precision machining. So then they'll try to add on to a machining company and make it more full service. Maybe they'll add on to it a molding company, something like that. Or they might be doing that, as the next bullet mentions, adding to an existing platform. If they already have a molding firm, they might want to add a contract manufacturer to that, or vice versa.
Absolutely. And to that point, Dave, the ones that have platform are not necessarily in the medtech industry. They could have a platform that's outside of our segment, but they're looking to add medical or medtech into their portfolio.
Yeah, I mean they might have precision capabilities outside of medtech, and now they want to get into medtech, right? Yeah,
absolutely.
And our last line there basically says, they are a little bit of kind of a rock and a hard place as far as they've raised these funds. They have the money to spend. They need to spend it. So they can't spend it unwisely. So they need to make sure that they're making good investments. However, they are actively looking. So as part of our thesis, why it still remains a buyer's market, and that medtech fits their objective.
Yeah, and they're competing with one another for those good companies.
And then on the strategic buyer side, we've talked about this already. They're first and foremost, it has to be a strategic fit. And they're constantly monitoring the companies that in the landscape that are strategic fits of all sizes, from startup essentially to actually seeing a patent, to startup to very late stage companies as well. They are investing in their future to bridge gaps that they have either today or they see for tomorrow. When I was at Covidien, I know we're always looking at times at slowdowns actually to make more investments relative to the future. And companies have to grow. If they're really thinking about their growth, they're incorporating both strategically organic and inorganic initiatives. And we've been asked, is there a formula that they're looking at? And we say there's a lot of ways you could think about it. So it has to be a strategic fit, but then after that, it has to make financial sense for them. They might be looking at 200 things they can do either organically in their R&D team or through acquisition. And at the end of the day, unless it's really an imperative strategic fit item, the NPV is going to win. The best investment that they can make for the money they have at the time. And then as far as mega mergers that are upcoming, that becomes whose crystal ball are we going to use relative to that. So I do have a question also from about orthopedic implants. There are not too many players left to be acquired. So is that creating a supply-demand competition among majors or mid-tiers to grab what is left? Yeah, I think that's really an interesting question, because it's become really focused on a few major companies that are out there, and they're competing. The major companies right now, what they're really focusing on is enabling technologies, and that's where the battlefield is how can they make it's not about the next new metal or next new plastic. It's how they can go after surgical infection prevention, and it's how they can enable technology to be able to get more data and improve outcomes through the data that they're generating and their robotic solutions, and then that sort of thing. So patient outcomes and making it more efficient and more precise. And then the mid tiers are trying to find niches that they can compete in. So I've seen like some of the mid tiers, they're going after more custom solutions that they can, and more that's where they can fit into the marketplace. So it's an interesting question, and there's definitely an ongoing battlefield relative to where you can find your niche if you're not one of the big companies. And the big companies, they're looking for enabling technologies or other things to differentiate in terms of surgical prevention, surgical infection prevention. So if you're in that space, you might be a good fit for them to think about. So anyways, at the kind of summarize MedTech M&A going forward this year, hot segments, manufacturing, supply chain, digital health, AI is the topic. You need to really be AI, or at least the machine learning if you're claiming it, because some people aren't when they think they are. So that gets delineated pretty quickly. But if you have it, it's definitely a hot area. Home care is seeing improvement in opportunity because more people are trying to do more in the home post-pandemic than going back in the hospital. Robotic solutions, of course, that's a high area of investment, and things that actually are complementary to robotic solutions as well. Financial services, like revenue cycle management, that sort of thing. And then healthcare staffing is also key because that's a huge issue in the hospitals. A little bit less active, right? A little bit less active right now is hospitals. I don't know if some people have seen, probably seen it in TMD, that some hospitals are having trouble right now. They're losing money because this transition to value-based care is from fee-for-service is really a difficult one for them to manage. And it's become a real challenge for them. And then, of course, ventilators. We, as Florence mentioned, we helped a small little company in Florida license their technology to GE Healthcare, and Ford made 50,000 of them. And there was a lot of other deals like that. So you can still sell your ventilator if you have a specialty niche. But overall, if you're a ventilator company, it's a little more challenging to get acquired at the moment, just because there's such a glut of ventilators out there. I'm also getting a question about what type of robotics, surgical or in rehab and robotic area. Yeah, and so what I'm really seeing there, Alan, is that it's really across all platforms, but it has to be real. It can't just be something that's on the drawing board. It has to be something that's getting traction, that you've been able to show the use case, and it's going to be cost effective with it. So, but it really is across segments. So I hope that answers that. Then, as far as MedTech M&A, going back to that, we are finding that the North America remains kind of the center of it, because a lot of the MedTech companies are frankly based here, or Europe. Europe has been doing pretty well up until this year. Europe, because of the war, got a little bit more uncertain. They're still viable, but just a little more uncertainty. India is a growth market. India is always up and down in terms of certainty. Africa it definitely has some uncertainty right now with everything that's going on. For a lot of different macro reasons. And then China's having a little bit of a slowdown right now because of the way that the pandemic has been managed there. So that's been a little bit challenging. Another question that we received, a breakthrough medical device for sleep apnea treatment. Are there companies looking to acquire technology? We have a unique device and couldn't be a game changer. That comes from Jitesh. Absolutely, sleep apnea is a hot space. Especially if it's in the area of being able to diagnose and treat sleep apnea at home. The traditional sleep lab are in reduction because people don't really want to go into a hospital anymore to get their sleep apnea diagnosed. So if it's home diagnosis, home treatment, that sort of thing, especially if it comes with some additional value add around data plays. Those things are very, very hot properties, and I think some of the major players have evidenced that by making acquisitions along those lines. So I hope that answered that question.
Sure. Dave, I'll just add something on Japan because it's one of the hot geographies that we actually have listed. In the last 10 years or even more, Japan was actually kind of not into the acquisition mode. However, they're in need of innovative technologies, and they have an aging population. They have money to spend. And so right now they actually are a very hot geography with regards to acquiring other companies.
So we just received a question about how are majors and mid-tiers rationalizing valuations based on strategic fit versus traditional multiples of sales or EBITDA. That's a great question. The answer is yes. It's always an interesting discussion when you get into negotiation with some of the majors and then the mid-tiers relative to valuation. As we mentioned earlier, the first and foremost has to be the strategic fit. Otherwise, we don't even get into the valuation discussion. It's really that simple. So once we get into strategic fit, then it becomes really how valuable is it and how competitive, how big is the market opportunity, What's the competitive landscape that we're looking at? What is the NPV value? If they can get away with it, they're always going to try to minimize the NPV value and then use traditional multiples. However, if it's something that's really unique and a strategic fit and the market's looking for it, it's a big market opportunity. We've seen it happen. We've been involved where the multiples go up because they want to have it. So another one of the part of that equation is FOMO. The fear of missing out does play a role in valuations. And so and in our role, we kind of like to see that happen because it's good for the seller that we're working with. So it's the outlook for 2023. We really see it's kind of similar to 2022, which means that it has declined from 21. However, it has stabilized. We're still at historically norms as far as the overall trends in terms of M&A. When it makes sense, it's happening, whether it's strategic fit or for a financial buyer. Good companies are going to sell, and if they're in a good market, it's going to be competitive, and they're going to get a good valuation. You might have some people on the financial side say that's not true, but we've seen otherwise when it's the right company and they're in a competition to spend their money versus letting their competitor, which is another financial company, make the acquisition. So they are going to be more disciplined in terms of if they get competitive to make sure they're making the right buy, but they are going to spend the money if it is the right buy. In terms of the rest of the world, there is a little bit of impact, as we mentioned earlier, from the war, but we think that's settling down in Europe in 23. They're probably the bigger impact there for a little bit. It will be the winter with the gas and oil and creating a little more inflation. And so they might have a little bit of recessionary time through the winter, but hopefully by next summer they'll be picking back up. Japan seems to be very aggressive right now. In fact, Japan in my career, Japan is as aggressive as I've ever seen Japan at the moment. China is a little bit internally focused, partially because I think they're about to go into their political season as far as where they go for their leadership for the next 5 years or so with their leader. Maybe that'll change a little bit once they get outside of that. Taiwan's in the middle of all that, but they can just keep producing really good products, and God bless them. And then Singapore has done a good job investing in this industry, and they definitely are creating opportunities that are out there across market segments. And the rest of the world it's opportunistic where you find the next deal. So in summary, I'll summarize and then we'll answer a few more questions as we have time. We are going to continue to see M&A activity in 2023. Buyers are moving to more stable industries, as MedTech is. It's proven to be. Earlier stage companies, they may end up moving from fundraise to M&A for the reasons we described earlier. There is lesser sellers in the market at the moment, which makes more competition for the buyers. So and we say lesser sellers compared to last year. And so that means that sellers if it's a quality business, they're going to get a good value. We are seeing an increase in partnerships to be a little more creative on valuations. If somebody needs to have a strategic exit, so maybe if the valuation gap is still too strong, a partnership might be a way to start, and that could be a licensing deal, that could be a distribution deal. There's lots of ways that can be structured. And as mentioned, more distribution deals are leading to M&A. And at the end of the day, quality sellers in MedTech will receive quality valuations because of the cash that's out there and the competitiveness that there is. So with that stated, I think Florence, that was our last slide. So I'll just see if there's any other questions that we have not answered. One question is, what is the average time to complete a sale with Japan? I would actually like to know the median on that. Japan can be very slow. It's known that Japan can be very slow. Although I'm seeing Japan be a little more aggressive right now, and I have to say that the multinational conglomerates, the big companies, the Fortune 500 companies, they're also very slow. So we kind of talk to our clients that basically 10 days, for one day in your world, there's 10 days in their world, but if you could get back to somebody in a day, it might take them 10 days. And you just kind of have to think about that ratio when you're working with bigger companies, because they have to get together with Elizabeth, and they got to go find Florence, and they got to go find Joe, and they got to get the committee together, and they're already working on other projects. They're traveling, they got conferences, the whole thing. And it just takes them a while to get together and say, hey, we're even interested in this. And then if we are, what do we have to go do? And those things, if it takes 3 weeks just to get the next meeting, then you have to have 10 meetings to get there. Now you're into 30 weeks just to be able to see if they're going to make a decision. So that can be the challenge when you're working with a large strategic, whether it's Japan or anywhere else in the world. So I think that answers most of the questions. Elizabeth, Florence, anything else that you want to add?
No, I think we had a lot of really good questions.
Yeah, it was great. I appreciate everyone's questions and conversations on this. And Florence and Dave, I always appreciate your deep insights into what MedTech M&A is doing and what we should look for going into 2023. I know we did have a question on how to reach out to you guys, and I was going to say, I believe there's a slide here with contact information. So please feel free to reach out to them. You can also find Dave and Florence's information in every issue of today's medical developments. So before I let everyone go, I do want to let all the attendees know that this is being recorded, and you will get a link to the recording in about 5 business days so that you can watch this on demand and share it with your colleagues. And I'd like to quickly thank our 2022 webinar series sponsors again. It's ISCAR, a leader for nearly 70 years in the development of a dynamic and comprehensive line of innovative precision carbide metalworking tools. And Renishaw, a global leader in developing technology that supports manufacturing process control, offering an advanced range of calibration measurement, positioning, and inspection solutions. And then today's single sponsor webinar sponsors are Kyocera SGS Precision Tools, pioneers of some of the most advanced cutting tool technologies resulting from rigorous product, coating, and material testing within KSPT's Global Innovation Center, and Makino, an industry leader in machinery design and digital innovation. Makino introduces game-changing solutions for premium performance, producing accurate, high-quality metal cutting and EDM machines. So I do think those are all the questions today. So again, thank you, Florence, and thank you, Dave, for your insights, and thank you to everyone who attended.
Thank you.
Thank you for having us.
Have a great day.
Afternoon.
Good day.
You as well. Bye.